This video will help you understand net income attributable and how to calculate it. If you don't know who I am, my name is Chris Dime. I'm a certified financial planner out of Edmonds, Washington, and I specialize in working with folks to and through retirement. In my last couple of videos, we talked about IRA funding, modified adjusted gross income levels, phase out ranges, things of that nature, over contributing to a retirement account and then needing to calculate how to get that money back out. Part of how much you'll need to withdraw from a retirement account if you made an excess contribution isn't just the excess contribution amount, but it's also the net income attributable, or NIA. Now, I promise net income attributable is not just a made-up term meant to confuse clients or increase my job security, although it does a great job of both. Net income attributable actually refers to the growth that is accompanied by an excess contribution to a retirement plan. So generally, if you make an excess contribution to a retirement plan you weren't supposed to, you'll have that excess contribution, and then presumably there's been some growth in that account as a result of that contribution. So in our last video, we touched on a few strategies. If you accidentally overfunded an IRA, for example, you'd need to take out the excess contribution plus its subsequent growth, or NIA. And so in this video, we'll break down how to calculate NIA so that you remove everything you're supposed to from an excess contribution. So let's jump in. Let's say hypothetically you overcontributed to a 401k or an IRA, and now you need to withdraw that excess contribution plus its growth or net income attributable. For the purpose of this video, without getting involved in the nuances of tax penalties and deadlines to remove your excess contribution and its NIA, all we're going to focus on today is knowing how much to take out of a retirement account if you made an excess contribution. As a refresher, if you did make an excess contribution to a retirement account, you need to withdraw that excess contribution plus its growth. The math on how much of your contribution was considered excess could be the entire contribution, or it could be a portion of that contribution. Use my previous videos to do the math on knowing how much you were permitted to put in, but let's just say hypothetically we know you made an excess contribution, so you got to back that money back out and you figured out that math. On top of that excess contribution, you'll presumably have growth in that account, and that growth is called net income attributable, and you'll need to calculate how to remove that as well. Now, there's some terms you're going to want to be familiar with if you're going to do a net income attributable calculation, and those two are adjusted opening balance and adjusted closing balance. So adjusted opening balance, this was the fair market value of your retirement account the day before you made that excess contribution, or as close to the day before as you can get it. Sometimes fair market value is not reported on certain accounts on a daily basis, and instead it's reported on a monthly basis. If it's reported on a monthly basis, then you just have to go back to the closest time frame for when you can accurately calculate fair market value. Now, if you made multiple excess contributions and you're trying to back out all of that and recreate history, you'll need to go back to the first excess contribution date and look at the day before's fair market value to determine your adjusted opening balance. But to keep it simple, generally it's the fair market value on the day before you made your excess contribution. The next term you're going to want to know is adjusted closing balance. This is the fair market value of the account on the day you're doing the calculation to remove your excess plus net income attributable that went into this account. Now, if you moved money into this account or out of this account between when you grab the adjusted opening balance numbers and you're now calculating the adjusted closing balance numbers, you'll need to reverse those. So for example, if you took out a distribution from your retirement plan between when you made the excess contribution and today, when you're doing this calculation, you'll need to add back in that previously taken distribution. And vice versa, if you did like a Roth conversion, for example, and you transferred money into this retirement plan during that time frame, you'll need to back that money back out for the calculation. So now that you know the adjusted opening balance and the adjusted closing balance of your account, let's look at the equation for calculating net income attributable. Now, that was simplified and confusing a little bit on purpose, so let's break it down a little bit further. We'll go from here down to something a little more explicit here. Essentially, what you're looking at here for the calculation of net income attributable is that NIA equals the excess contribution times the difference between the adjusted closing balance and the adjusted opening balance, that difference. You divide that by the adjusted opening balance, then you multiply that number by the amount of excess contribution you made, and there's your net income attributable. Let's run through a quick example. Let's say in an alternative universe, I watched my last two videos on Roth IRA contributions, and I now realize that my modified adjusted gross income was too high to have made a $6,000 Roth IRA contribution last year. Instead, After figuring out my phase out ranges, I was only permitted to actually put in $5,000. Therefore, I made a $1,000 excess contribution. But since I made it last year, presumably there's been some growth in the account, so that $1,000 contributed to the total account balance I had previously, and it helped as compounding investment assets grew. Let's say the day before I made this excess Roth IRA contribution, my account opening balance, or AOB, was $10,000. But now I realize I made an excess contribution, and I'm trying to reverse engineer what I did so I can get the money back out and be in good standing with the IRS. So let's say my adjusted closing balance is $17,000. So adjusted opening balance, $10,000. Adjusted closing balance, $17,000. Excess contribution, $1,000. If we plug all those variables into our equation, then we're going to end up with net income attributable of $700. That means on top of my excess contribution of $1,000, I'll need to withdraw that $1,000 net income attributable, $700, for a total of $1,700 to be removed from my Roth IRA. Now, some of you might be thinking, hey, wait, last year the markets actually went down quite a bit. So what happens if you make a contribution and your account ends up at a lower adjusted closing balance than the beginning adjusted opening balance? So let's repeat that previous example, but let's just say instead of the adjusted closing balance being $17,000 with an adjusted opening balance of $10,000, let's say the adjusted closing balance actually was $9,000. Now intuitively, that means my adjusted closing balance is less than my adjusted opening balance, which means I'll have a net negative net income attributable. And if we run the math on the variables I just gave you, then we're going to end up with negative $100 of net income attributable. So the math is still the same though. You take your excess contribution amount, which was $1,000, and you add the net income attributable. In this case, the net income attributable is negative, so you actually subtract from your excess contribution, the $1,000, and you end up with a total amount you need to remove from the account of $900. This may seem a little bit counterintuitive, where you made an excess contribution of $1,000, but now you only need to take out $900. And that's because the negative net income attributable offsets how much of your excess contribution you need to withdraw. Now, this does not mean that the goal should be a negative net income attributable, where your account loses so much value that you don't have to withdraw the excess contribution in full that you originally put in. Of course, that's not a good thing because it means you lost money in the capital markets. It's just important to remember that the net income attributable plus the excess amount that you contributed both need to be factored in together, and you really shouldn't rush to withdraw your excess contribution amount and then go calculate net income attributable, because one could offset the other. Because if you do that and you break apart taking first out the excess contribution and then going and doing some math on the net income attributable, if the net income attributable is a negative number, then technically you withdrew from your account more than you needed to. As we all know, if you withdraw money from an IRA, especially if you're before 59.5, you'll pay income taxes and you'll be hit with a 10% penalty for an early withdrawal. And that's essentially like just getting kicked in the shins from an IRA standpoint, where you took out the money from an excess contribution, but you took out too much, and so now you get to pay penalty taxes on the money that you never should have put into your IRA in the first place. As a last side note, that net income attributable is considered taxable income, and you will have a tax liability. And the net income attributable taxable amount is taxable in the calendar year that you made the excess contribution. So as a refresher, if you funded 2022's Roth IRA in December of 2022, and you're doing this calculation in 2023, then you better do this math before filing your taxes. Otherwise, you'll need to do an amended return, most likely, to factor in the taxable portion of the net income attributable. If you do the math before the tax filing deadline, then the net income attributable will be taxable income by April 15th or October 15th. However, if it's 2023 and you're making your IRA contributions for the tax year of 2022 and you haven't filed your return yet, then any net income attributable taxable amount will be owed in taxes on 2023's tax return, which you won't file until April or October of 2024. And again, as a refresher, the 10% early withdrawal fee no longer applies to net income attributable, but it will apply if you over withdraw from your IRA. So it's very important that you get this math correct. Odds are the investment custodian you're working with will help you with this calculation, but it's always a good idea to double check. and of course, work with your tax professional to ensure you don't run afoul of any IRS guidance. So hopefully that was helpful in clarifying how to calculate net income attributable. If you have questions, feel free to drop me in the chat below, send me an email, we'll get you squared away. Have an awesome rest of your day. We'll talk to you later. Bye.